GM, good morning. Welcome to the Milk Road Show, the daily crypto show where March Madness has nothing on the madness of watching your portfolio during a crypto dip. I'm your host, Jay Hamilton. It's Thursday, March the 20th. And this Tuesday, Coinbase released a new institutional survey. And this survey got me so fired up and so pumped that we had to bring somebody from the team on to talk about it. Some quick highlights. 86% of those surveyed said they expect to increase their allocation to crypto in 2025. 59% plan to allocate over 5% of their assets under management to crypto in 2025. And 84% of institutions are either already utilizing or expressing interest in stable coins. You know what the survey said to me? Bullish, bullish, bullish. Like so many reasons to think that we are still in a bull cycle and we have a long way to go. Well, at the same time, the bearish vibes have just been never ending for us. So to join us today is John D'Agostino, head of strategy for Coinbase, where he focuses on their strategic advisory and partnerships with, you guessed it, institutions within the crypto space. Also, he has been kidnapped before, but I don't know if we'll have time to jump into that story today. If you guys want to make sure you're up to date every day on crypto, you want to subscribe to the Milk Road newsletter. If you're not already subscribed, few newsletters you want to catch from this past week. One was we went through our 5 most bullish charts in the crypto space right now that you should be paying attention to. Go check that out. Link is in the show notes to subscribe. Today's episode is brought to you by Definitive Advanced Trading on every chain. It's also brought to you by Coinshift, powering top crypto treasuries with their yield-bearing stablecoin CSUSDL. John, welcome to the Milk Road Show.
Thanks so much for having me, Jay.
Yeah, absolute pleasure. Okay, before we jump into the results from the survey, I just want to set the stage and the context of what this survey, who was surveyed, and what this survey was about, and a bit of the methodology. So I'm just going to share my screen. Can you just give us a little bit of background and context of who was in the survey?
Sure. Well, I'll start with the survey was done in partnership with Ernst Young, which I think in and of itself is an important note. There's a lot of historically, some of the big 4 accounting firms and advisory and consulting firms were not really very active in crypto. All that's changed now, and there really isn't a large scale institutional vendor in the accounting, banking, or admin space, particularly since the changeover in administration, that is not interested in participating in this ecosystem. So that's the first point: is it's being done with a big 4 accounting advisory firm. I think the sample set was roughly a little under 400 institutional allocators that were surveyed. I'll note a couple of things about this, which is particularly unusual for these types of surveys. The asset sizes are skewed towards a much larger size. So not a lot of small mom and pop shops. That's an important thing, because as you think about these numbers, 400 may not sound like a huge number, but 400 managing on average $1 billion or more each, that's a large pool of capital being allocated. And 352 is the exact number. And so 18% over 51 billion, 52% being above $1 billion. So the mean and the median are roughly in the close to $1 billion asset under management.
Other things to note,
sorry,
I would say, are the dates. So this survey took place in early January, Jan 13th to 24th, which I think is actually great. You guys really threaded a nice needle here with this survey being post-election. We hadn't yet, when this survey came out, we didn't yet know about the strategic Bitcoin reserve or the digital asset pile. So there is some stuff that has happened since then, but I think we directionally knew that stuff was coming. So any other things that you would point out on who is involved?
It's a great point you make, because somebody might look at the survey and say, well, hold on, we've had this market volatility over the last couple of weeks, and would those numbers be different? What's important to understand is that institutional allocators of the size, they don't make capricious decisions based on short-term volatility trends, right? So depending on what time you catch them, could the numbers skew a little bit one way or the other. But these are institutions that take a lot of time to consider new asset classes. And they're looking not just at price volatility and price direction, they're looking at market infrastructure. Is this an investable asset from an institutional perspective? Do the mechanisms exist that me as an institutional allocator, who I myself I'm probably a fiduciary. I owe a fiduciary responsibility to someone else if I'm a hedge fund or even an asset owner. Do the conditions exist under which I can trade? That's how they're thinking about this. Then price movement, quite frankly, is sort of the last thing. Then they're thinking, is it a liquid enough environment that I can get in and out of these markets? And then finally, is there alpha there? And the alpha could be from just price direction, prices moving either up or down, because you can trade both sides of that trade. Do variance trades exist? Basis trades, inter-arb trades between jurisdictions? Is this sufficient enough and robust and clear enough market that me as a large asset allocator thinking globally can extract alpha? They don't change their mind based on a short-term price trend.
Yeah, I don't think anything would have changed in this survey had you done it, I don't know, last week or something like that. The other thing I just want to bring up quickly, to set the stage, is who participated from a region standpoint. So 61% US, 28% Europe, and then the rest of the world, much smaller percentage. So a big chunk of the survey is US. Important to know that as well.
Yeah.
Okay, before we jump into the specifics of this survey, give us what was your big takeaways? I know you've been doing a few podcasts and a few shows now. What are the stories that you find that you're sharing the most?
Yeah. So first of all, it resonates with what those of us who speak to these allocators on a regular basis and these institutional participants. It's what we kind of have seen intuitively over the last, and these are long ranging conversations going back several years. The trend has clearly been positive. Before we went live, you and I were talking about this really interesting bifurcation of vibe right now, where understandably, given the price action, the retail side is a little bit negative at the moment, but on the institutional side, it's never been better. And because we've seen over the course of, like, if I just kind of step back, and I know it's a luxury to be able to step back and think about these things calmly. If you're able to step back and think about this, 6 months ago, it was a fever dream to think we would be where we are from a regulatory perspective. Consistently over the last several years, the number one driver of institutional allocation decisions in the digital asset space has been regulatory uncertainty. And that really was a code word, to be honest. I don't really like that. I mean, there's in my career of always trading in idiosyncratic assets, commodity derivatives, high frequency trading, and other stuff. There's never been certainty. Like, I can't recall a time in 20 years where if you polled investors and said, "What are you worried about?" the answer was always regular. So regulatory uncertainty becomes this sort of code word for, really, I don't like the attitude of the regulators. They're against me. If you talk to HFT, right, high frequency traders, there was a period of time where the regulators didn't know what was going on and life was great. And then a book was written called Flash Boys, and suddenly everybody said, well, the regulatory environment is uncertain for high frequency traders. That was code for the regulators are out to kill us. So over the last 5 years, when you've heard regulatory uncertainty in the US is what's stopping us from entering the market, that was a polite way of saying, we don't understand why, but these regulators in the US seem to want to kill this industry, even though Congress, which creates the laws, is not doing it through law, through the right way. So I don't want to be too flippant about it, but that what a vibe shift from just 6 months ago to now, where 6 months ago, honestly, maybe I was being a little bit too paranoid. If an institutional allocator or sovereign wealth fund said to me, John, do you think we could wake up one day and the US administration could just ban Bitcoin? I would say, well, that's highly unlikely, but I would have to acknowledge it was a non-zero probability. Now we know it's not a non-zero. It is a non-zero probability. It is a zero probability. Sorry. So that's a huge shift. And we will have legislation coming out. We have the Genius Act, and Congress will act. So, but I think you'll always hear people say, I'm concerned about regulatory uncertainty, because that kind of is code for either I don't like the asset class, or I don't want to get into it, or I don't want to learn about it. But I think optically that should be gone now in the US.
Yeah, and you can't underscore the significance of that shift. Like, this is why, as you mentioned earlier, this divergence, this bifurcation that is happening between retail sentiment and institutional sentiment, it's almost like mind-boggling. Like, I gotta say it the way I see it. Like, I've it feels like we're being gifted a buy the dip right now. Right now, look, I don't know how the deep the dip goes, and is this the bottom? I don't know. Probably not. We probably have further to go. Like, Jay Powell did not change interest rates yesterday, and we don't know if he's going to change them in May. And Trump and Scott Bessent are still saying we want lower assets. So, like, they're giving us all those signals. QT is ending,
Yes.
all this stuff, and I don't want to get into that deep conversation with you today. We'll focus on the report. Although feel free to jump in if you have any thoughts. But the main thing that this report just shows to me is there's so much enthusiasm on the institutional side, and
Yeah.
there's so much flows coming. Like they are exposed, but
Yeah.
they're only going to increase their exposure
100%.
significantly this year and the years to
Yeah.
come. And like, I don't
Yeah.
know, like, what else do you need? Don't leave
Sure.
right now. That's all I'm saying. If you're listening to this, do not freak
We
out.
won't.
Do not leave crypto. Stay here. Stay.
And a couple of things about that is one is that they're not doing this emotionally. Like I know, like a lot of folks in crypto on the retail side, they really believe
Very.
in the reorganization of society around these principles, and that's a beautiful thing. That's a wonderful thing. The institution, the allocators that are giving you this bullish information, they're looking at this in a cold, analytical fashion. So some that might be bad. That might be, oh, they don't believe in the underlying thesis behind blockchain and decentralized ledgers and decentralized trust. But you should be optimistic about that because the tech is winning. That's all they care about. That if you believe that ultimately price direction will move in the direction of tech adoption because this is a superior technology and way of organizing ourselves as a society around trust. The institutions are telling you, however slowly, however frustratingly slowly, because that's how they operate, this is winning. So bring one data point you pointed out. This notion that I think close to 60 or 70%, I get the exact number, of funds surveyed said that they're going to start trading more than 5%. For a lot of people, that might not seem material, but 5% is a bit of a magic number in hedge fund world. If you have any listeners who know about hedge funds or private equity or any fund in general, generally when you set up a fund, you have to tell your investors what you're planning on doing. So I'm going to launch a credit fund, equity long short fund, commodities fund, metals, whatever it is. And you produce a document called an offering memorandum, and you say, this is what I'm allowed to do. And your investors give you money based on that. And so if you start an equities hedge fund, you can't just suddenly put 80% of your investors' capital into credit, usually, unless your plan is very broad, which most are not. But there's a de minimis exemption. And it's like 5% generally. That's like the standard in the industry. So you can like play around with credit or commodities or crypto below 5% without having to tell your investors, without having to get permission from them. So it's this magic number. That's why you're seeing 5. So when I see they're planning to allocate over 5%, what I'm hearing is something profound, which is these funds are now going to have to go to their investors and say, we believe so strongly in this that even though when you gave us your money 5, 10 years ago, wherever it was, and we said we would do X, we now want to do X plus crypto. That's a big decision, Jay. Hedge fund managers, fund managers, they don't like doing that. Because when you do that, you have to give your investors the right to redeem, even if they're
Mhm.
locked up. It's considered a material change to their stratum, their offering memorandum. So that tells me that they have supreme confidence. This is not just a thing I'm fiddling with. Or a lot of them were doing it because they had a young portfolio manager who was like, I'm going to leave if you don't let me do some crypto. And they kind of did it to make them happy. This is now something significant enough for us that we're going to change our organizational documents to allow for it.
If you're only trading on centralized exchanges, then you're not going to make it. The best traders know the alpha is on chain. Definitive, founded by Coinbase alums, lets you trade any token on Solana, Base, or any chain all in one platform. What makes Definitive different is its advanced order types. You can execute limit, TWAP, and stop loss completely on chain. Plus, you get the best prices as your order is routed instantly through every DEX and liquidity pool, getting you up to 19 times lower fees. Trusted by funds, whales, and the milkman himself, now you too can trade like a pro. Milk Road listeners get a tasty glass of milk with zero fees on your first 25,000 at milkroad.definitive.fi. Meet CSUSDL, the stablecoin built for institutions and DAOs. Don't just hold basic stablecoins, earn yield, all without compromising security. Backed by regulated real-world assets and secured with institutional-grade risk management by our friends at Stakehouse Financial, put your treasury cash to work, earning native yield and protocol rewards. Built by the team behind Coinshift, which is trusted to manage over $1 billion in business treasuries on chain, including Aave, Gitcoin, and hundreds of leading institutions, CYCSUSDL is gaining traction at milkroad.com/Coinshift. Very interesting. Very interesting. So there's a shift in mandate coming from these institutional investors, which, as you said, That's not to be taken lightly. That
Nope.
involves a restructuring of their documentation, reaching out to
Yeah.
their LPs, allowing them to redeem. Okay, wow, that's so that 5% is a significant number. I got the slide up here just to
Yeah,
dive deeper into
that's
these
why they chose
numbers.
5, by the way. That's the magic number. Like,
Right.
it seems random, but it's not meant to indicate necessarily size. I mean, it may only go to 7 or 8. It doesn't mean that they're gonna go up to majority position, but it's a sign, it's an indication of trust. It's a barrier for trust.
Very interesting. Okay. And what we're seeing here is that in this slide it shows 2024 versus 2025, and you can
Mhm.
see that a lot are allocated already in 2024, but they
Yeah,
plan to increase their allocation in 2025, a lot of them
yeah,
above
and what does
20.
that tell you? It tells you they've had a good experience overall,
Hmm.
not just from a price movement, but from a market infrastructure movement. We have more ways of entering the market. We have, I think it was announced today that the Solana ETF is moving forward, or
Mhm.
some announcement happened today with Solana
The
ETF.
futures, I think the futures
The
ETF or
future,
futures is
yeah,
now live, and so
yeah,
that should lead to the ETF next.
yeah, and
Okay,
it,
I want to step back to 'cause the report is sort of structured in three sections. We have market outlook, which will get our audience and our viewers very excited because everybody wants to know what the market outlook is, and it's very interesting to have 352 institutions who are managing over $1 billion or an average $1 billion all give us their market outlook, right? Like we don't get that on the show every day.
yeah,
And then it talks about investment use cases, and then also we'll get into some DeFi and stablecoin use, which is very interesting, I find. So
yeah,
let's start with market outlook. When we start there, what I find very interesting is they talk about the current allocation of crypto. And basically, what we're seeing here is that there is a plan to significantly increase holdings within their crypto allocation in 2025. And what stands out to me is the why really stands out to me is 59% say why is because of an expectation of higher returns than other asset classes. So there's a real belief that this asset class is going to outperform the rest of the market.
yeah. And again, what's important is, again, these are sophisticated, highly sophisticated investors. So what that doesn't mean necessarily, and again, this may come to the chagrin of some of your retail viewers, it doesn't necessarily mean that all of them just think the price is going to go up. Like that's fine. There's a certain portion that are directional. What I see is that close to 60% of these allocators believe that there's going to be alpha generation capability within the asset class. Now that could come from direct price, just long only price direction. That could come from arbitrage trading, basis trading. That 60% number says to me that highly sophisticated investors who have an array of way of making money within a market see the infrastructure of this market as supportive of their capital. Again, I know we all want the price going there. Now, what the good news is that over time, and I'm not saying all of crypto is commodity, but it does behave commodity-like to some degree. What we know from my old days when I was head of strategy for the largest commodities exchange in the world is that when you have more and more market participants in the asset class, the underlying reference asset, whether it's crude oil, natural gas, Bitcoin, whatever, tends to go up, tends to move up because more market participants enter. They need that asset more for collateral on shorts or longs. And the overall price direction tends to increase over time for scarce assets, at least like Bitcoin. That's a good thing for Bitcoin and other scarce assets in crypto. So it's a wonderful sign that these businesses, who their only job, by the way, is to find alpha. And by the way, they're doing this for their job is to screen every asset class in the world and find alpha. That's their only reason for living. And they've decided after, probably asset class have been around for like 10 years, I'd say really 4 to 5 in modern form. In a very short period of time, a majority of them have decided to dedicate material capital to a new asset class. I need your viewers to understand, despite how depressed they might be at their bags, how profound that is. That didn't happen for commodities. That didn't happen for new asset classes like CDOs. And it is unthinkable 5 to 7 years ago that an entirely new asset class would take this position of prominence amongst these institutions.
Hmm. Interesting to get that perspective of how significant you feel like this move is. Okay, let's look at the you mentioned they don't necessarily think price is going to go up, but the response on this exact question, which is, what do you expect to happen to crypto prices in the next 12 months? 79% said they expect prices will be higher. Now, this was in January, and we've dipped since then. So even more would probably say it's higher now.
Yeah, I mean, look, I kind of take back what my point still stands is that they're able to extract alpha not just through
For
price
sure.
direction,
For sure.
but there's a
Yeah. Yeah.
general obviously there's a general consensus that there's going to be more participants entering the market, and therefore general price increase. I'd be curious if the question was, because what the cryptocurrency prices again, some people might think Bitcoin, some people might think basket. We have the Coin 50 index now,
Yeah.
so if I could get all of them here and chat with them, I think you'd still see some of them expand that definition. But that's
Yeah.
that's generally. I think the other thing that's saying is that prices going up also means increased liquidity generally because you're not extracting open interest from the system. So I think that's their way of saying we see more open interest, more volume, more liquidity, and a general rising tide for the asset class overall.
Yeah. I had the same thought as uh, it would it most of these survey questions, in this case, the question was, I expect cryptocurrency prices blank in the next 12 months and will trend higher, was the 79%. But as you said, it's crypto, it's not Bitcoin specifically. And my guess is, and we'll actually, you know what, actually, let's actually go to that. Let's look at what are they investing in, because that's in here. Let me just pull that up
Yeah,
quickly. What tokens? Here it is. So 73% of surveyed investors hold crypto beyond Bitcoin and ETH.
yeah,
Beyond
that was
Bitcoin and
surprising
ETH.
too. Yeah, that's good. That's great news.
25% hold Doge. 25 hold Doge as a meme coin. 25%. That's wild to
Yeah,
me. Looking at these assets, some of the, I mean, it makes sense. A lot of these, they're holding the top 10, right? So maybe
yeah.
they're in indexes, or maybe they're just making their own index because that's the best way to allocate, is just, hold a
And
basket.
and again, just to get back to the optimism here, one of the kind of I think incorrect criticisms you hear from time to time is, oh well, all the activity, all this excitement's really only in a few tokens, only in that small. Well, that may be true, but look at equities. Seven FANG stocks or a small number of FANG stocks. Look at commodities. Like you go to the Chicago Mercantile Exchange or NYMEX where I used to work. Natural gas and crude oil represent the vast majority of open interest. So most asset classes have clustering at the top. I'd argue to some degree we're reaching a point with this analysis that crypto actually might be more diversified at the top level than some other traditional asset classes. So it's just only natural that you gravitate towards a more limited pool of assets. Investors, especially non-professional investors, they can't spend time analyzing dozens or hundreds or thousands of anything. And so that clustering isn't unusual for mature asset classes. But to your point, I think a lot of people would have been surprised to learn the interest in some of these tokens, down market on liquidity, and that's all. It's just a very good sign for diversification and growth of the overall sector.
Yeah, there's clearly a belief beyond just Bitcoin. And I mean, 97% said that they hold Bitcoin. So, like, that's
Yeah,
obviously, I mean, A, that's great. Okay, the buy-in for Bitcoin is here. But beyond that, it was very surprising to me to see all the other assets that they hold as well. Okay, I want to go back up to the concerns,
yeah,
and then, because that was a very interesting point as well. Let me just find that. Here we are. So a lot of talk around, um, what are the challenges and what are the concerns
mhm,
that are, as you mentioned. What the big concern has been regulatory uncertainty, and you put that in air
mhm,
quotes, as you've pointed out to us. But moving forward, there still are concerns. What are the
yeah.
concerns that institutional investors have?
Yeah. So I want to start with the security of asset custody because it looks prominent there, but again, I look at that number and I'm shocked at the converse of it. 67% of institutional investors are no longer concerned about the security of asset custody. Again, unthinkable a couple of years ago. This is a challenging asset to think about vis-a-vis custody because it combines the principles of high tech with a bearer asset. That's challenging for lots of institutional investors who are used to just like things sitting at DTCC and not having to worry about it, right? It's the same reason that maybe some investors might not want to invest in real assets. Like how do I'm Harvard endowment or I'm endowment XYZ. I'm now going to hold like timber. that's in a foreign country. Like how does that all work, and how do I ensure the
Mhm.
physical integrity? Right, that's
Mhm.
challenging. It's just
Mhm.
it's off the run, as we would say. But crypto has similar characteristics. It's a bearer asset to some degree, but it's also highly technical. So am I going to do the work to understand how this is kept safe? Um, again, just a couple of years ago, the notion to me that 67% of institutional investors would, in a short term, not think it's a challenge or an issue to custody and hold these. Again, it tells me they're getting smarter on it, but it also tells me that firms like Coinbase and others have gotten better at communicating how far along we are in the safety and security of custody, and that's wonderful. Volatility is interesting because, again, it goes back to like how you answer the question, because these institutions, and this might be the difference, like hedge funds, they like volatility.
Mhm.
Volatility's a non-volatile asset is bad for most hedge funds. They need it. I think what they don't like, what you're seeing here, and again, shockingly low. I think this is a low numbers, that 53%. They don't want is what we used to call volatility of volatility. So they want volatility is like ice cream for hedge funds. You like it, you don't want it jammed down your throat a gallon at a time. Okay,
Mhm.
so they want these nice volatility bands. If they're too narrow, that's no good. That's no fun. You can't make money. But if they're too wide, or they're non-predictable, that's problematic. Now we do sometimes, because we have assets that trade on sentiment. We have these kind of irrational. No one knows why you've gapped up or down. I will remind everyone that in the last 2 years, crude oil, the bedrock commodity of the global economy, went negative. It literally went negative. You had to pay someone for a brief period of time to take the world's most valuable commodity off your hand. And it's shocking to me that we don't talk about that more. So I guess my point is, they're used to this stuff. It happens in lots of different assets. And so what we see now, with what I see from this, the big thing I see about this survey is, yes, there are still issues and concerns, but these issues and concerns are about the same as other standard asset classes that these hedge funds, these asset allocators, uh, actively invest in.
Very, very interesting,
Remember when
because
crude went
we
negative? Do
we
you
wouldn't see
remember?
that. Yeah. Yeah, yeah, yeah. And well, and I like that you're taking the inverse here. What stood out to me was that the two of the biggest concerns, volatility will decrease over time, but we're going to continue to be quite volatile for a while. We're not going to change that one. But regulatory concerns being number one is being addressed quite rapidly.
Mhm.
And and then also custody of these assets is also being addressed, as there's more improvement on the ways to custody and the assurances that we can give to these larger investors and the ways they can do that. So it feels like I also see a lot of optimism for we are directly addressing these concerns quite rapidly right now.
Again, that's why I think looking at the inverse of these questions is
Mhm.
important. How many people have been convinced versus last year versus the year prior? And that is a function of the technology getting better. I think it's also largely a function of how we communicate. We've gotten better at communicating. Firms
Mm.
like Coinbase that have chosen to go public have been willing to expose themselves to the scrutiny of public markets and the myriad of analysts and investors and critics. And after a while, when those critics don't find fatal flaws, you start to trust in these entities. And it does take time. We were fortunate as an industry to experience unreal dramatic growth, in prices, in pickup, in wallets. And unfortunately, just mathematically, those growth rates are not sustained. You can't grow 10,000% a year forever. You'll be larger than the global economy very quickly. So maybe the pace of growth from a percentage basis has narrowed a bit. But the notion that 67% or so of institutional investors, I think if you ask them how comfortable they are with real asset custody, like timber, gold, etc., I think more would say they are scared of it, they don't understand it, than cryptocurrency. That's something to be very, very proud of.
Yeah, it completely. It's just remarkable, the shift. Let's look at this is to do with this shift that we're talking about. Another stat that came out of this was one of the questions was, which of the following asset classes does your firm assign crypto to? Where do you place crypto within your allocation. And this really surprised me that a lot consider it its own category now, its own asset class, which
Yeah.
we really haven't, we've never been there before. We've never been in a place where we're now our own asset class truly.
Yeah, and if you understand, there's a footnote here that the hedge funds are less likely to characterize it as a different asset class, and that's an important distinction. Not all institutional investors are the same; they don't have the same bias. I think of them as two big buckets. There's fiduciary investors and non-fiduciary investors. So, a fiduciary investor is any institutional investor that has bosses, that has investors themselves, right? And then non-fiduciary investors, I think of as like sovereign wealth funds and insurance pools, where they're the ultimate asset owner and they kind of can think about things how they like as opposed to a fiduciary. They're more likely to want to put things in a discrete bucket. And that kind of makes sense when you think about how they think about the world and their duration of holding and whatnot. Hedge funds, professional investors that are just seeking alpha, they bucket things by alpha type. So how do I extract alpha from this? And then if it's similar to another thing, then that means the strategies are similar, the ways of analyzing the market are similar. So they want to bunch it in there. And again, I think it's similar to the way I'm not saying it all crypto is a commodity, but I am saying as a former commodities derivatives trader and executive, it behaves similarly to how commodity and commodity derivatives behave, and therefore they're going to think about it in that bucket. So that makes perfect sense to me that you would see the asset owners, the non-fiduciary investors, want to label it something very unique for reporting purposes, and the hedge funds just think about it in terms of its components.
Yeah, yeah, it's a great point, John. Just a star on the show today, man. Just killing it. This is so awesome. Let me go to the interest in tokenized assets. So like beyond just crypto, because really this is the future that we all, I think, talk about and we see is like, let's tokenize all financial assets. It makes so
Yeah,
much sense. There's so many reasons.
yeah.
What are institutional investors saying about that?
I mean, it's one of these things where we all know where the puck is going. We all know where it's going. Um, it's a matter of when. So, not to bore you with a quick little story, but even though I don't look it, I'm quite old. I hope I don't look it, but I'm old enough to remember when I was a freshly minted MBA and I got my job on the NYMEX floor. And this isn't like 1960. This is 2004 or five. The most important commodities markets in the world. The price was set by a bunch of mostly guys back then, unfortunately, screaming and yelling and sending hand signals to each other on this massive floor on Lower Manhattan. And it was anachronistic then. Even as a freshly minted MBA, I was like, this is insane. Why are we not doing electronic trading? And the response was everything I heard back then, I'm hearing now. The system works. All that electronic trading stuff, it'll never, you can't trade options on a screen. There are too many strikes and months, and the human mind is always going to be superior. And the only valid argument was that first one, which is it did work. It worked shockingly well. There were very few trade breaks, $1 trillion of notional trading occurred. And there is a certain responsibility. If you're going to innovate and displace a critical system, like the pricing of crude oil, you better be damn sure your system works. And one of the things that's been really great about even some of the recent catastrophes in crypto is we've seen proof of concept. We've seen proof of concept that blockchains are strong, immutable, they work overnight, they're fast, they're cheap. And it takes those experiences to gain the trust because we know that that's a better system. We know that my 11-year-old daughter, when she's my age, I know that we will prefer tokenization, just like I knew that in my lifetime, we'd stop using crazy hand signals and use electronic trading. I know that's the next generation. So it comes down to when. And the when is partially overcoming corporate inertia and not wanting to change. And that's again, that's some of it's valid. Some of it is very valid. You have to prove you don't want to be the Jay, let me ask you a question. If you went on a plane and the pilot came out and said, hey, I've got a brand new engine design. It's mathematically beautiful and perfect, and we're the ones testing it today. You might be like, look, I trust in science. So I do think we have a responsibility to prove that we're ready, but we're proving it every day. And it will happen. I hope it happens fast. I hope I can see it in my career. I think I will. So when you look at the advantages of tokenization versus kind of static securitization, There's no question that that's better, and that's the next generation. It just really comes down to when. And when you have like people like Larry Fink saying, I think in my lifetime everything will be tokenized. That gives us the confidence to experiment more. And by the way, it's been a horrible month for crypto overall. Tokenized security, tokenized U.S. Treasuries volume increased by 35%, 34, 35% in the same quietly, right? The boring stuff, the non-sexy
Mhm,
stuff, right? That's all proof of concept. It's
mhm,
actually happening. So I'm
mhm.
very, very, very confident that I'll be lucky enough in my lifetime, my career, to see two paradigm shifts in the way assets are priced and traded. Open outcry to electronic trading, traditional securitization to tokenization.
It's let's hope that it happens sooner rather than later. I like the view that it'll in our careers. Come on, it's going to happen sooner than that. The thing that really gets this stuff gets me so excited, and I hate the term RWA because it's it's like
Yeah.
the widest bucket of all time. But like you mentioned, tokenized treasuries growing rapidly right now, tokenized private credit growing rapidly right now. Like we are seeing this, and as you said, it's not sexy. It's not what most of retail is going to invest in, but it is a massive part of the financial system that has
Mhm.
a lot of reasons to be tokenized. I mean, in the survey, 72% of respondents said that they plan to invest in tokenized assets. So I'm not talking about like the crypto tokens that we currently invest in. I'm talking about,
Mhm.
as you said, tokenized treasury, tokenized
Yep.
real estate, tokenized private credit. 72% plan to do invest in that by 2026. And currently, that's small right now.
Yep.
The number of like, there's only what, 20 billion, I think, roughly in RWAs on chain. Like, yeah, I guess if you include stablecoins, it's a big, but usually stablecoins are separate from this. It's still a small number that is growing so quick that I think it's just another reason to be bullish.
Well, it's just better tech. It's just
Mhm.
better way to organize ourselves. It's not if I can settle in T plus 5 seconds versus T plus 1 day or T plus 2 days. It's not just convenience. So though we have entire economies built on convenience, it's real money. It's collateral. It's freeing up a tremendous amount. It's increasing confidence. So it's just better technology. It's programmable. It's smarter. So it will win. And what you're seeing is people realizing, okay, not I always knew it was better tech, but let's face it, the better tech doesn't always win, right? The
Mhm.
classic, beta was supposedly better than VHS. Better tech doesn't always win. So now there's a realization that it's got enough of a foothold that it will continue to be used and experimented with. And we see things like, for example, like people talk about stable coins. Uh, Tether was the seventh largest buyer of U.S. Treasuries by country, more than Norway with their world's largest sovereign wealth fund, more than Germany. So that tells the market this technology is not only not going away, it's going to become critically important. I don't know, I'm not even old enough to know when's the last time the US government gave a stamp of approval to an asset or a technology the way it's done with the strategic Bitcoin reserve and blockchain and Bitcoin. So it's definitely not going away. They're seeing pockets of increased use cases like tokenized treasuries. And so they know it's just a matter of time. And so, of course, if you're a betting person, which all of these people are, that's what they do for a living is bet, and you're asked, do you think you'll do this more or less a year from now? Of course, the answer is more. So that again, your viewers should be very, very excited about this because these are dispassionate, cold-hearted investors who are not emotional. They don't care about the underlying.
They
They
don't care
just
about
want.
decentralization. They don't care about the
I,
ethos of crypto. Like, let's be real. Like,
yeah,
that's the truth, right?
they're
They
not
don't.
interested in your philosophy. They're interested in safety and security and making money, and they believe they'll be able to do this more and more on this technology.
Yeah, yeah. I mean, fantastic, great, awesome. High fives all around. Before we let you go, John, I want to just touch on DeFi and stablecoins because those are two
Yeah,
areas that are getting a lot of use and an increase in use. And this number really stood out to me that
yeah,
currently 24% participate in DeFi. I mean, that's already a big number. 24% of these
yeah,
survey respondents participate, but they plan to get to 75% of them want to participate in DeFi in the next 2 years. That is
yeah.
huge.
I was surprised by that. I'll be honest. That That surprised me. I knew it would be higher. I didn't realize it would be that much.
And
There's
and
yeah.
what does this say to you in terms of like how are these institutions going to use DeFi? Are they using it to in sophisticated investor ways to hedge? Is that their plan, or what do you think their plan is?
Yeah, I mean, I don't know about a hedge. There's lots of vehicles now, and increasingly there will be vehicles that provide good hedges, both on an idiosyncratic token basis, also against beta to the market. So Coinbase, for example, launched our Coin50 index. It's a dynamically weighted index that takes the 50 top vetted tokens from the Coinbase listed ecosystem and creates one-stop shop to hedge out market beta or get broad market beta beyond the top two tokens, inclusive of course. So there'll be more and more of these ways for these hedge. When I see again both fiduciary and non-fiduciary institutional investors say that they want to use 3 times as many, up to a super majority are planning to use DeFi. I think that's telling us two things. One is they see enormous potential. They potentially see alpha opportunity because the DeFi markets are maybe a little bit more opaque. There's a little more fragmentation of liquidity. Again, professional investors like that. Things that might be scary to individual investors, that's where they find their edge. That's where they find their alpha. So that's one piece. The second piece is they see DeFi as an experimentation lab for where the kind of the direction of this technology is ultimately going, and they want to be ahead of that. They don't want to, a lot of folks who, it's funny, a lot of folks who are negative on crypto, who are institutional investors, are really folks who can't admit they missed the trade. Right? Think about it, Jay. Like you're paid, you're only paid to do one thing, get the trade. And if you're a hedge fund manager and an investor calls you up and says, hey, the top performing asset in the world for 10 out of the last 11 years has been Bitcoin. Why exactly did you not get in that trade? I think there's a valid answer. The valid answer is, hey, you paid me to trade equities. I'm not an expert in other stuff. And so I wasn't focused on it. That's actually a very fair answer. But some of these folks don't like admitting that they were just wrong. And so they'll start just maligning the asset because they have to. What this is telling me is a lot of them are thinking, I don't want to miss the next trade. I don't want to miss that next big thing. And it looks like DeFi and the way assets trade within DeFi and the types of assets that trade over DeFi, that's one element of it. I think a lot of derivatives will trade in a decentralized manner. The derivatives market tends to dwarf for commodities. The derivatives market tends to be larger than the spot market. And so they see opportunity there. But it's an encouraging sign that they don't want to miss out on that next iteration of innovation because a lot of them missed out on the first time.
Mhm, mhm. You brought up Coin50. I want to double click on that quickly
Sure.
because index funds are not a big part of crypto yet, but
Mhm.
index funds are a big part of other asset classes and a great way, particularly for retail
Yeah.
investors, aka
Yeah.
our listeners, a great way to get exposure. There's a reason why your grandpa and your dad and everybody in your family probably tells you just to buy the S&P 500, right? Like keep it simple, don't try to outthink the market index. Very often we had Eric Balkunis on the podcast a few weeks ago, and he talked about why he wrote the book The Bogle Effect, all about John Bogle, who was really the one to create
Let
index funds,
yeah.
absolute legend in investing, right? Tell us a bit about Coin50. What is that index fund? And is it tokenized? Did you buy it on chain or did you buy it through equities?
So you can buy it through a perp currently, ex US, and we're hoping now with the friendliness of the current administration to have that accessible for US investors. It represents, as the name says, 50 tokens that trade on Coinbase. They've gone through the Coinbase vetting process of being listed on Coinbase, and it's also key is it's dynamically adjusted. So periodically, tokens can fall in or out depending on their open interest, liquidity, and the way their liquidity profile looks on Coinbase. So you have a couple of things there. Is you get some diversification. It is still weighted heavily towards the top few tokens. But you get diversification. You get a mechanism to enter and exit beta positions in a cheap, efficient way. Again, I think it's really, really important. If we want to onboard 1 billion people into crypto, we have to get over this notion that individuals, retail, and even institutions will have the time and energy to devote that we do to the underlying thesis behind all of these tokens and their use cases. It's not reasonable. Most people, even if they have the capacity to, don't have the time or interest or energy to spend all day thinking about any investment thesis, right? I don't spend all day thinking about stocks in my portfolio, credit instruments, et cetera, et cetera. And so we have to create easy, good UI interfaces and having some that mute some of this volatility. While what's most importantly, and what's great about the Coin50 index, if you look back historically, you keep a lot of the upside, right? The goal is to mute the downside vol, but not get rid of the upside vol. So if we can create instruments that are easy, simple, provide some downside protection, and get people excited about investing in the asset class and think of it as a long-term holding, stable holding to grow their wealth over time, we will get that incremental 700 million or so people on board. And so Coin50, I think of it as sort of a barometer of the health of the industry. Indexes are wonderful things. Like, they don't have to be perfectly designed. The Dow Jones Industrial Average is sort of mathematically incoherent. It doesn't allow for stock splits or things, but it's a barometer of the health of the industry, right? And so we think the Coin50 index is very well designed, but if it could become standard, then it becomes just an entry mechanism for retail, and then for institutions, it becomes a really useful hedging tool.
And as you said, I think everybody listening to this believes in crypto and is long crypto and believes in the future of crypto. But do I know which L1 blockchain is going to be the blockchain that wins? Not long term, right? Like, I think it's going to be Solana or Ethereum right now, but maybe not, right? Like, AOL had the early lead in the internet and it didn't win there. And so it's, yes, you can, if you are active every day and you want to follow this stuff and you're really in it, yeah, sure, you can go and try to pick your winners, but it has been
Yeah.
proven over and over again that you are much better off not to try to pick your winners yourself, but just to go with an index. So it's great to see
It
you
doesn't
guys
mean people don't
developing
have the
this.
capacity to do that. It just means that we have busy lives, and money isn't necessarily the most important. Money isn't what most people want to wake up every day thinking of focusing their energy on. So let's give them efficient, cheap mechanisms. Let's let them get the benefit of blockchain without having to maybe wake up every day and think about blockchain or cryptocurrency. That's how we onboard the next wave.
Yeah. Yeah. Okay. Last thing before we let you go, John, touching on stable coins, because I mentioned that we wouldn't. I want to make sure we squeeze it in. 84% of respondents either use or express interest in stable coins in the future. What does this say to you?
I mean, it says that the killer use case continues to be stablecoins. They're a killer use case for holders and users of cryptocurrency, people who want to keep their value locked into the cryptocurrency ecosystem to move to bridge from one asset to another. But increasingly, they're becoming important for governments. As I mentioned, the U.S. government now has a vested interest in ensure. If you believe that if you're an American who believes that U.S. dollar dominance is an important thing for our national security, you should want to encourage the creation of instruments that the vast majority of which flow into U.S. treasuries. That's just common sense, right? That's what we should all believe. And so it's important geopolitically. It's important economically. They're working. That's the key. They're working. They're working during nights. They're working during weekends. We've heard there's been some recent articles about cryptocurrency deals, like M&A transactions that were able to, and in some cases, people needing overnight value transfers that were able to be done when every bank in the world was closed, or at least every bank in the US was closed. That's an extraordinary thing that can only be accomplished through this technology and through stablecoins. So we see the interest from an investment perspective, but we see an interest from a geopolitical perspective, a policy perspective, and a stability perspective for our entire economy. So if that's not a use case, I don't know what is. And we've also seen how they just work under the most crazy of situations. I
Right.
think about, like, I was there when MF Global collapsed at the New York Mercantile Exchange. It took us months to figure out what happened. And you see now where there's instances in the digital asset space where, because of the transparency of blockchain, the market participants can figure out almost immediately what the causes were and decide to support or not support overnight, literally overnight, through stablecoin transactions, value transfers. That's just unthinkable a few years ago.
Yeah, that's a really good point too.
Stablecoins are key for that.
Yeah, I hadn't thought about that. We could do a whole episode on stablecoins alone. It could
Yep.
be it's a whole deep dive. On that note, on Monday we have Rune Christensen coming on the show. Everybody,
Ooh,
that's founder of Maker Sky. So we'll be diving deep into stablecoins with
yeah.
him. John, absolute pleasure to have you on the show today. Thank you so much for your
Thank you.
time, and shout out to you and your team, and to EY, to one of the big four accounting firms, for jumping into the space and for putting out this fantastic report. Everybody listening, we will link to the report in our show notes so you guys can go and check out the full report. We'll link to the Coinbase 50 index that we mentioned today as well. Yeah, thanks so much for listening, and thanks, John, for joining us.
Thank you, Jay. Have a great day.
Before I let you guys go, I gotta let you know about the crypto.com card. This is one of my favorite cards to use in the space. If you want to spend your on-chain dollars on everyday stuff, coffee, flights, whatever you are spending your hard-earned dollars on, here's why I like it. No annual fees, up to 8% cash back on your crypto in crypto. So you're keeping your money on chain, you're getting your cash back, not in fiat, but you're keeping it on chain. Also a bunch of benefits like Netflix and Spotify subscription. And if you're a traveler like me, you can get lounge access depending upon the card that you have. Hit the link in the show notes to check out the card and get yours today. Thanks everybody. Have a wicked awesome day. We'll see you again tomorrow. As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your number one resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening, and my friends, have a wicked awesome day.